Hey guys, welcome back to the channel. Today I'm going to be conducting a review of my dividend portfolio using the GetQuin website and the GetQuin app. If you've never heard of GetQuin before, the link is in the description below. It's a fantastic website for tracking your portfolio and also tracking your dividends. More on that a little bit later. Now, the reason you haven't seen a dividend portfolio review from me for quite a while is that the portfolio has been complete for quite a while, and all I've been doing is adding to my original positions that I've held in this portfolio. However, of late I've sold a few of these positions based on what happened in the market. With the market turning bear, I wanted to reposition it so it was able to take advantage of the tailwinds that are coming and be slightly less risk adverse, essentially, so taking slightly less risk in my portfolio. So I sold a few positions and repositioned them to take advantage of the growth that I expect to happen in the future, and to be able to maximise my dividend growth as well. So without further ado, let's get in there and let's take a look at my dividend portfolio. Hey guys, welcome to the GetQuin website, and here we are looking at my dividend portfolio. So as you can see, over the course of the day I'm up £15, over the course of the week £300, over the course of the month only £23 because I made some pretty big repositions here only in the last month or so. And then year to date, I've not had this website so long, but I'm up £1,500, which is obviously looking at about a 10% return, which in this current market I don't think considered to be too bad at all. Anyway, let's have a look at my portfolio composition these days. So number one, we have Penfold Group, a water company. I am not 84% up on this one. There seems to be a little bit of a glitch in there. I do hold 50 units, but I'm actually at a slight loss on that company. I'm not sure why it's doing that at the moment. AT&T, I own 62 units. This recently went through a demerger with HBO Max. More on that in a little bit. I'm currently sat with a position of 62 units, a total of £1,040 invested, 23% down. Next up is BP. I own 170 units. I have a 47% return on that at the moment, up £200. AbbVie, I own 6.3 units, a position of 740, 70% up. Royal Dutch Shell, another energy company, absolutely blowing it out the park at the moment, up 35% on this one. Good things coming from this company down the line. GSK, I'm up 25% on these guys. These guys are about to do a demerger and of their consumer healthcare section, creating a company called Haleon. I'm holding on for that because I want to own both parts of this company. Coca-Cola, I'm up 27%. Raytheon Technologies, with the unfortunate situation that is going on in Ukraine, has absolutely bounced up lately. I'm 80% up on those guys as well. Starbucks, this is a position that I've added to recently. I owned about 5 shares in this company not so long back when the last portfolio review took place. Now I'm up at 10 units. I could not resist the 37% drop in the share price. I actually already had a pretty decent price, but I've actually came in and I'm 8% down at the moment, but I've managed to increase my cost basis there. PepsiCo, I'm 26% up on them. Visa, 10% up on those. Legal & General, just a 5%. Almost break even on 3M, another buy opportunity there in my opinion. Reality Income, 10% up on those. Texas Instruments, this is a company that I've added since the last portfolio review. I believe that chips are obviously the future, the revenue, the tailwind that's coming from this sector at the moment, demand and supply. It is best to be positioned in a company that is going to take advantage of those tailwinds. It was a struggle whether to choose Texas Instruments or Avgo. I went for Texas Instruments, but in my pension fund I actually went for Avgo, so it's a bit of a toss up here. T. Rowe Price, that was again another new ad. This company has been growing its dividends for nearly 30 years now, double-digit growth nearly every time as well. Has been affected by the ongoing situation in the world at the moment, but I'm very pleased to be holding a position in that and see a good return coming. Again, Lockheed Martin doing particularly well, 30% up on those. Again, defence company, so the situation in Ukraine has, unfortunately or fortunately, whichever way you look at it, contributed to that. Another new joiner since the last dividend portfolio review is Warner Bros. Actually, the keener-eyed amongst you will know that this isn't a dividend stock, but it's spun out of a dividend stock, and I've decided to keep hold of the units that I was given for free, and I've added a few units as well myself. Currently 22% down, but the consensus share price for this company is almost at the $70 mark, guys, and it's now currently sat at $15 a share, which is insane value for this company. This could give you at least a triple digit return. I'm expecting maybe 200-300% out of this over the longer term as Warner Brothers pays down its debt. Caterpillar, the old stalwart, I really wish I'd managed to add more of this when I actually bought in originally. Again, up 62%. Another new joiner to the portfolio was Snap-on. This company has been growing its dividends double digit splendidly for 15 years, which is absolutely brilliant, and I'm going to keep on top of and add to this company over time. Ashtead Group down 19%. Since the last dividend portfolio review, I've added Microsoft and Apple back into the portfolio. Yes, they're down a little bit at the moment, but they're down 30% from their highs in the most part. So again, good time to add in. Great value in these companies, and I'll continue to average down. If they go further, I will add more money. I have actually got about £500 in cash in the portfolio, ready to take advantage of further dips. Rio Tinto have added into the portfolio completely 4 units. I expect raw materials to do incredibly well over the coming years, just purely because of the demand that is required for the energy sector, electric cars. Rio Tinto is positioned extremely well to take advantage of that. Recently did a special dividend and increased its dividend absolutely massively. Its current yield is 10%, and it's a sustainable 10% as well, which is pretty difficult to get sometimes. Next we have Diageo, 36% up on them. I'm a bit undecided what to do about this company, because I do want to take out the profits, but I know it's a great company, but I think I could get better returns. Having been up 36% and it's stagnated at 36%, I think I can plough the money into somewhere else and return an extra 36% on top of that. Detra Pharma down 20%, Halma down 14%, Croda down 15%. All of these three companies are quite high dividend growth companies and could be considered as growth companies. They've been hammered by interest rates going up, but over the longer term, I think these companies will do just fine. The dividend growth is absolutely fantastic, albeit starting from the 1 to 2% margin. So I'm going to consolidate my position there and hold on for the long term, and then eventually the dividends will come rolling in and they will keep growing double digits each year, so the dividends will double and increase my yield on cost massively. And lastly at the bottom there, Bunzl up 6% again. That's another one that's stagnated. I may consider selling that to reinvest the money off elsewhere for better returns in my portfolio. Now to move on to the sales from my dividend portfolio over the last 6 months or so. I actually got out of Tate & Lyle at a 68% gain, £68 gain, 6% gain. Intertech Group I sold for a 7% gain, 2%. Pennon Group, this is where the mess has come. I've not actually made that loss because I still hold them in the portfolio, but they consolidated their share price, which has caused a little bit of confusion. Sage Group I got out of because I think there's a better opportunity in finance companies over stateside and better opportunities for dividend growth as well, but I still made a small gain of £16. National Grid, I decided to de-risk some of my exposure to energy. I liked having BP, I liked having Shell because they're extremely diverse. National Grid, not so much. They're very limited in what they actually supply. It's electric, it's gas, and yes, they're doing well right now because the gas prices and the etc. are right up. I just didn't think that was sustainable for the long term, so I de-risked that a little bit. Highly on there is in the wrong place. IBM I sold to essentially almost break in half so I could invest in Microsoft and Apple, because again I think there's more to be had out of the growth in Apple and Microsoft share prices, and IBM's dividend growth has pretty much been flat for the last 3 years or so, and I didn't really see that improving that much at all, so I thought I'd move it to companies that are going to grow their dividend and their share price is going to grow as well. And I took a 13% gain on IBM, which isn't too bad, as to be fair, and I'm happy to have got that out the way. Same with McDonald's, it's stagnated. I got 20% out of it. A fantastic company to invest in, McDonald's, no question about it at all. I just thought that my money would be better off in Starbucks, which is massively beaten up right now, and is still a growing company. It's growing its dividend higher than McDonald's is, and its share price has the chance to grow a lot more as well. That's the only thing I had against McDonald's, otherwise I would have kept it. And then Unilever, for me, I did actually make an £84 loss on that, lost 11% on it, but I just don't see this company going anywhere. The share price growth has been flat or has been declining. The dividend growth has been flat or of course it's not declining because it's still just about maintaining that growth, but it's growing it at like 0.5%, which is getting to the point on pathetic. So I decided to move my money on elsewhere. Moving on to total performance, I'm 12% up. Price gains, as you can see there, dividends 1.76% up, total of 12.4%. Invested capital there, and costs and losses not associated. Split pretty almost evenly between 36% Europe and 63% North America. And then here we have my dividends. So June is going to be a bumper month for me, going to get £71.81 according to the GetQuin app. As you can see, that's how it's going to be broke down there. will get my final dividends from IBM, so that's good, and Sage Group as well. And then you can see that the dividends have been announced next month for July and for August, and there's still going to be a lot more added to that, basically what I got in April. So this is really good way of tracking your dividends. Like the previous months, I've got 27, 24, 37, and in February I got 38 when I actually set the GetQuin app up to track my dividends quite well. So this is a really handy way to see just how well your dividends are growing. Then you can see the transactions that I've made here as well, dating all the way back to June, but you can continue even further, so you can see my buys and sells. Whenever I make an investing decision for my portfolio, guys, it will get tracked through the GetQuin app, so you can use the description below, you can use the link in the description below, follow me on there, and even track your own portfolios, so you can do exactly like I've done here, see your dividends, see your total return, see everything in really obvious great graphics, and socialize with other investors, and also follow me. There's so much information available through the GetQuin app. It's absolutely great, guys. I highly recommend it. If you use the link in the description below, you can get yourself set up relatively quickly. So guys, that brings you right up to date with my dividend portfolio. Do you think I've made the right decisions for my portfolio? Do let me know in the description below if you have anything that you wouldn't have done or you would have done, or any stocks that I have that you don't think I should have, etc, etc. If you could drop a like on the video, that'd be great as well. If you have 5 minutes, do look into the GetQuin app, guys. It's absolutely great. You can use it on your computer, you can use it on your phone to track your portfolio seamlessly, and dividend tracking is a really hard thing to come across, especially for free, and this app does it all for you. All you have to do is sign up, link your portfolio, add your positions, and it does it automatically from then on. What could be easier and simpler than that? Thank you very much for watching today, guys. Hopefully I'll see you in another investing episode. Catch you later.